All right. Episode, 44. Episode 44 of Exit Liquidity. We got Cole from Elixir here. Uh,
GM,
bef-
GM.
Before we hop
GM.
into Elixir, I wanted to hear a bit more about you. We have a very branded Exit Liquidity question, but I had a convo with somebody before that I wanted to ask you about some like previous investments you made. The I heard you hit pretty big on the Pepe run up. Is that true?
Yeah, I think I remember I have this tweet that I will never delete. Pepe was like 8 mil market cap, and I posted like Pepe trillionaire with like a Pepe guy like jumping into a pile of coins. Um, and yeah, I remember I bought like a pretty like decent amount, and I was like, and I didn't really traded much before that. Like I'd been kind of on a break because there was just no opportunity in the market, and so I was like, all right, like this, I feel like this could have sticking power. Like I saw a lot of people that I know and like talking about it in group chats, and that's pretty rare. So I was like, all right, like let's give this a go.
Yeah,
I wake up the next morning, it's like over doubled. Um, and then it pretty much just like went up only from there. And so yeah, I kind of like traded it on the way up a little bit, like would buy and sell, but ended up selling when the Binance news happened. So I think it was like a 10 mil to like 1.2 billion run.
jeez,
Probably like the highest percentage trade like I will ever see in my entire life. So yeah, it was pretty wild.
that's awesome. And it's funny because like in your bio, it's me and Ali were discussing this, and when I'd mentioned it to him, he thought I was referring to like the Neuralink or like 3AC or like serious investments that you made. So I wanted to ask a little bit about your background there and kind of your investment history. Are you full degen or a bit more serious?
Yeah, so those are real investments. The 3C thing at this point, it's like just a joke. Like I just leave it up there. It's like a battle scar, I guess, in my view. Like I don't think it's worth when you make a bad investment trying to just like erase it from your history. I think embracing it's a little bit more fun. But a lot of people think it's a joke. Like those people that have like risk management at FTX, 3AC, Celsius. No, it's not a joke. Those were like probably more serious investments at the time, which is ironic given the outcome of 3C. I invested in their fund, like their main fund, as well as Starry Night, which was their NFT fund, both of which like obviously are fully zeroed out. Starry Night might launch like a DAO and give tokens to investors, but like I highly doubt it'll be anything like what it could have been if they hadn't committed fraud. But yeah, so those were more serious investments. I think for about 2 years, I mainly just did angel investing. Invested in probably about 40 companies, 20 of which roughly like I have no clue what happened to them. Never launched, just kind of dropped off the face of the earth. And these are like pretty legitimate projects. Like these weren't just like pre-sale scams. And that's one of the most shocking things that I've seen is that like how you get rugged angel investing like typically isn't like the token rugs. It's just that they never launch a token. Like they build a product and it maybe doesn't go anywhere or maybe does, and they just kind of run it and just use your money until the pot runs dry, and then who knows what happens after that. So yeah, I think I've become like way more selective and slow with angel investing since, and obviously it's not my main focus anymore. But that was one of my main focuses previously. So yeah, lots of angel investing, lots of like full on chain degen stuff. But yeah, happy to share more about the degen side of things as well.
Yeah. Yeah, that's usually where we start off with, I think, with most of our guests is we like to hear about everyone's favorite like exit liquidity story. Basically just uh I mean everybody goes through it. I think it's like a rite of passage at this point um to be in crypto or to really call yourself in crypto. So would definitely be curious to hear your favorite memory of being exit liquidity.
Oh boy, probably like UST. would be one of my like
That's
yeah, I think that's probably like the biggest like hit I've taken on liquid money. Like with the 3C stuff, it was maybe worse in like percentage loss and maybe even dollar terms. But the difference is like when you invest in something like that, you're like locking money up for like 10 years, right? It's like a 10-year fund. And so you kind of like have already just counted that money gone. So it stings a little less bad than watching like liquid cash that you're, putting money into and pulling money out of. It's like a bank account basically, just evaporate. So yeah, UST was for sure. I was like ultimate exit liquidity. I had like a good portion of my capital in there. Watched it like I think in March the year before it collapsed. It had depegged and then hashed just threw like $1 billion at it and went back up. And so I was like, all right, like this thing's safe. There's big funds behind it. Like they'll just protect it to protect their interests. And then when the depeg began in May of last year, um, yeah, it was I guess a year and a half ago now. Wow. When that happened, like my friend, he was working at one of these like giant funds with huge Terra involvement. He was like, "Oh, don't worry about it. Like, don't worry about it. Like, we're gonna like throw some money in. Like, we're just gonna bring it back to peg." And he's like, "Oh yeah, we're talking to 3C guys. Like, they're gonna throw in. Jump's gonna throw in. Like, don't worry about it." So I was like, "All right, I'm not gonna take like a 10% hit on this. Like, I'll just wait." Wake up the next morning, it's at like 60 cents. I have like 4 missed calls from this guy, and he's like, "Yo, I was trying to wake you up. Like, 3C doesn't have any money, so like they can't help. They were gonna be like the biggest source of capital to repeg this. Like, Jump is backing out. Like, they want to start selling theirs to get like whatever they have left out." He's like, "You should just sell." So I was like, "Damn." So I sell, take a 50% loss on a stable coin, which is like the worst feeling.
yeah.
And moved on from there. And so it didn't that like kind of scarred me. Didn't really do much trading. Just was kind of in like preservation mode since then. Up until Pepe was actually like my first trade. So I had like the ultimate exit liquidity where I'm used as exit liquidity, and then a year later I get like the ultimate exit liquidity on the other side. So there was really nothing in between those two.
Damn. Yeah. We've talked about Luna tons of times on here because we were both me. I mean, I don't think we had like the level of like critical thinking nor the level nor like the network to tell us like what 3AC and those guys were thinking at the time. Like we were kind of just like one of the best ways I found to like humble myself when like I seem to be doing well in the markets and stuff is I remind myself that I bought Luna on the way down, like as it was deep pegging. So like
Well,
we were definitely on a
the scariest thing that I like thank God didn't happen is when Luna was unraveling. I like moved all my so yeah, this is the other irony. So I moved all the remaining money onto FTX because I was just like so sketched. I don't know. I was just like, dang, I just like want fully out of on chain. And I'm sitting on FTX, and this guy, who ended up like running another firm that ended up rugging, I forget what it was called. It was like the Maple Finance firm that rugged all the loans. Um, but he was in this group chat, and I thought like he's like a god trader. I never really like talked to him or anything, but it turns out he was like another fraudster. But he posted this group chat like short interest is so high on Luna, like it's gonna have like a massive short squeeze before it goes to zero. And at this point, like I just lost like half my net worth, like liquid net worth. I'm like, all right, like maybe I try for like the Luna short squeeze. And I'm watching on FTX. I'm like, I'm thinking, okay, like I've got like all my remaining money here. I could like 3x long or even 5x long. And like if I catch the bottom. And then I was like, you know what? No, like this is just like chasing losses. Like I'm not going to do it. And sure enough, it never bounced, like literally never
yeah.
bounced. It just went straight down. Because there it wasn't just like the free markets in play. Like it was just this whole mint and burn cycle that tore it to zero. So that is like the one thing when I look back, I'm like, wow, thank God I wasn't that stupid. Because then things would have really, really been bad. But yeah, so that was the aftermath of of that.
Yeah, it's get a little PTSD whenever we talk about this. But
Mhm.
so how do you go from angel investing, trading Pepe, to kind of discovering the problem that Elixir is solving. What was your thought process when the idea initially like came to fruition?
Yeah, so actually, like I was building Elixir through all of this. And so yeah, just like a little bit of background. First got in crypto back in like 2016. Was the president of the blockchain club at UC Irvine, where I went to school. And then shortly after that, like right before DeFi summer started, in like late 2019, early 2020, I was writing the first DeFi newsletter on Forbes. And DeFi was super early then. So when it started taking off, I ended up dropping out of school. COVID was happening anyway, so I thought it'd be a good time to like take a gap year and just see what I could do with DeFi. DeFi blew up. That kind of gave me my start, I guess. Um, and was also working with Philip, who's Elixir's CEO, my co-founder at the time at his last company, which he ended up selling. It's kind of like just like a part-time thing. Was working with like Solana and Flow Network and like a lot of good names, and so became close with him. He became a good friend and someone I really respected, and so he came to me in early 2022, almost 2 years ago now, with this idea, and I was like, dang, like that, it makes a lot of sense. And he kind of came up with this because his last company was the largest refer of projects to GSR. So he was close with GSR, but he was also seeing the other side of the projects complaining about like how expensive liquidity is and how inefficient that part of the market is. And so yeah, a couple months after he brought the idea to me, I dropped everything else I was doing, paused on angel investing mostly, kind of went full time with him. We started building our team, seed round finished, and then yeah, the rest is history. So yeah, all the stories I told happened concurrently with building Elixir, which also made it more stressful. It's like you're starting a seed stage project, and then also like watching your net worth like evaporate. Um, and so yeah, it was a fun time though. Looking back on it, it wasn't so bad.
Yeah, definitely. Definitely an industry that puts some hairs on your chest. I would say having to go through stuff like that. Um, before we get into like some, I guess like a little bit deeper questions, would you be able to just give us a quick, just high level summary of what Elixir is exactly and how it works?
Yeah. So Elixir is a high throughput DPoS network built entirely off chain, purpose built to power liquidity on order books. So essentially, like through the origin story that I shared briefly before, we started finding that the liquidity constraints that projects were facing weren't isolated to centralized exchanges. Decentralized exchanges face the same thing, but even in a more extreme form, where they're reliant on 3 or 4 firms to provide all the order book liquidity that their users rely on to trade. And obviously, like there's a huge cost to this. Typically, for at the exchange level, that cost is paid out either in a combination of maker incentives and cash, or what's most common is they have these like maker reward programs that they pay out to incentivize this liquidity. And so they essentially like pay out tokens, like either pre-launch tokens or liquid tokens of their exchange, to makers at like an absurd rate. So prior to Elixir, what we noticed is like the APRs for most of this capital were like in the 3 figures, where essentially an exchange can have like $5 million of order book liquidity, and they're paying $1 million a month worth of tokens for that liquidity. And if you look at these programs, like it's typically like 3 or 4 names that capture the entirety of those rewards, and they end up like at the end result is like the exchange is super reliant on these 3 or 4 names, and they're paying out anywhere from 100 to 300% APR. In some cases, in like liquid tokens in exchange for that liquidity, and it's this horrible cycle where at that point it's like you have to keep paying those rewards, or else like you lose your lifeblood, right? If you decrease them or remove them, those names are going to leave, and at that point, like your exchange is worthless. So we decided like, wow, like we can fix this by building this infrastructure that allows retail users to essentially compete for those rewards, completely permissionlessly just by putting money directly on the order books and take advantage of those maker rewards. Obviously, it's a bigger challenge than it sounds like. In order for that to be like fully decentralized and trustless, and have no reliance on like centralized parties, you basically have to build a like layer one off chain from scratch. Something that has like the latency that can fit within the latency restrictions of these markets, and also power it in a way where people can see what's happening at all times, and recognize that they're not like relying on like a centralized firm to do it or an individual to like provision their liquidity. So yeah, that's what we built. We kind of went live in a beta form a couple weeks ago, and just within a week, we took like Vertex's order book liquidity from, I believe it was at 9 million, and it's now at like 23 million. So we over doubled it, and currently we control about half of their order book liquidity, which is our biggest success metric, is like the percentage of liquidity that we control across these markets. So yeah, it was a great first case study, and we're going live with our other integrations in the coming 2 months as we near the end of the year. And yeah, we're super excited about it.
Yeah, likewise over here, definitely. You said you kind of, I mean, obviously, like we've seen the pools on Vertex and how much TVL you guys are controlling over there, but you mentioned you kind of went live, and I know that the testnet is available for anyone to run a node for right now, but I believe mainnet launch is still Q1 of 2024. What changes between what's happening now versus when mainnet goes live?
Yeah, so we're calling this a trusted mainnet. Essentially, the protocol itself is working in full function, but right now it's trusted because we as a foundation are controlling most of the key infrastructure. This is because like it's pretty crucial for us to be able to test and push updates, and fix anything that comes up. It's safer for users, and it's better for us to kind of QA this in a production environment, that's super controlled, versus like a decentralized mainnet where you lose a lot of that control. So over the next probably like 4 months, roughly, we're going to be slowly decentralizing key pieces of the infrastructure, leading up to the final like decentralization event, which will be like the full launch of our validator network. So right now in testnet, we have about 14 or 15,000 validators running. They're not actually like they are contributing to like a certain instance of the network, I guess, that we have running with on centralized exchanges, but it's just a small amount of capital, and it's just company money, for testing purposes. Once we decentralize, those validators will be converted to like actual mainnet validators, and the top subset of maybe 50 based on like tokens delegated, token stake, uptime, latency, factors like that. The top 50 will contribute to consensus and actually earn like protocol fees, as well as potentially other rewards. And then the rest of them will be kind of in like a zombie state, like a sleeping state, queued up. And if any of the validators that are actually contributing to consensus go offline or get jailed because they passed like malicious order flow or whatever it may be, the next one will just sub in. And so that's kind of like the system that we're creating, and what the path to mainnet looks like.
Interesting. Okay. That's definitely like a new take on transitioning from like a trusted or like a more open test net to a main net. That's you would be going from like I think last I checked there was something like 15,000 validators, and you're planning on when you launch mainnet you'll have 50 trusted ones to start out, or I guess just based
Yes.
off of uptime and stake.
I mean, they'll all be in the consensus set, or they'll all be
Yeah.
queued for the consensus set. But the thing is having like 15,000 validators all individually verifying information, it's not practical. And so at least like for what we're doing, where latency is pretty crucial. So to reduce that, we're gonna have like this giant queue. 15,000 at launch will be in that queue. But the top 50 will be the only ones that are actually like validating real order flow at that point. One thing that's cool though is about having that queue as well is like as the network grows and more integrations go live and we're supporting more pairs, the need for data processing increases. And so that consensus set may expand. Like it may start at 50, but we ultimately it may look at like 500 or something along those lines. And we expect that there will be like a lot of turnover in that queue as well. I think the only ones that will kind of sit at the top of that like consensus set, always active, always earning rewards, always validating orders, will probably be like institutional providers. So we're working with a lot of the bigger names to have nodes running, validators running like at launch. And at that point, like users can delegate to those, or they can create their own and try to compete with them. But outside of that, I think individual ones will probably you'll see a lot of turnover where like they're online and then they go offline, a new one queues in. So I think the queue, like the queue of quality validators will probably all have a chance to participate in consensus like within a week of launch.
Okay. Okay. Yeah, that makes sense. I mean, even as it is right now, from when I was setting mine up, it seemed that from like the total of 14,000, there were a lot that were had kind of just gotten set up and didn't have much uptime, or people who wouldn't necessarily be live during like a full mainnet event. So I think that definitely
Yep.
makes sense. Shifting over to like users a little bit more, I guess specifically LPs. I'm wondering, so as far as I understand it, you guys are, as of right now, basically market making on the same like XY equals K curve for, I guess right now Vertex. Um, will with what we've seen so far for that same strategy for like spot AMMs on chain, there's obviously been like there's impermanent loss, LVR, MEV. There's all kinds of issues that lead to like degraded LP performance. But I don't believe that that's the case here. Can you talk a little bit about why that is, or what kind of like what makes that strategy different when ran through Elixir?
Yeah. So, I mean, fundamentally, order books are just more efficient trading venues than bonding curves. Where that x times y equals k comparison comes into play is when we were designing this, like part of this is that we wanted to create this trustless infrastructure that can be universally leaned on to support liquidity on pairs, whether it's a Bitcoin perp on DYDX, like the most liquid on-chain perp market, or like a shitcoin perp on some new DEX, right? Like you need one universal strategy that can work across all of them. And our focus wasn't really on like proprietary trading strategies or things like that. Like we didn't want this to be like some market making black box. Like what we wanted is this to be infrastructure that exchanges can lean on to enable their retail users to supply liquidity directly to their order books. So to do that, like we tried to create like the most familiar, simple risk return profile possible, and that kind of looks like Uniswap V2 LPing, right? And it also is like very broadly effective. It can work on any type of pair, on any type of liquidity, on any venue. And so for us, it's like the profit center for an LP isn't the strategy itself. This isn't some like proprietary super low latency trading strategy that is has a goal of like beating out like Wintermute or Jump. Like it's not possible to do that and be decentralized. So our approach is like this: like users can come in, supply liquidity directly to an order book, and take advantage of these reward programs that the exchanges are offering. So the goal is that the strategy doesn't make money, doesn't lose money. It kind of sits delta neutral, but is active enough to where it can allow users to tap into these maker programs that these exchanges offer, and also create like a broad backbone of liquidity on these exchanges. So they right now like you'll see these exchanges, most of their liquidity that's paid for just sits at top of book and kind of is algorithmically adjusted, which isn't super impactful for like large traders. Like if you're a really small trader, that might be fine, but it's not possible to trade millions of dollars worth of positions with just top of book liquidity. So we create like this core backbone of liquidity that kind of sits on the wings of those orders and goes all the way up and down the order book, similar to like what a bonding curve would look like. So users don't face too much volatility with their collateral, And the whole time they're also taking advantage of these rewards that the exchanges are paying. Last thing I'll mention is on like the MEV side. There's kind of two components to what we're doing. There's like the on-chain side and the off-chain side. At the exchange level, pretty much all the exchanges that we're integrating with have these off-chain order book modules. So we're broadcasting order updates like directly to this off-chain ledger, basically, which then when takers fill those orders, post on chain. And so number one, like we're never paying gas to update orders, which is crucial for us, right? To be efficient and not rack up like massive gas charges and figure out how to then get those paid for by the users. And number two, we also don't have to worry about any kind of MEV. So yeah, so as far as IL goes, it's very similar to Uniswap, but the rewards are like significantly outpace that. And then as far as MEV goes, it's not a concern for us.
You're muted, Ollie.
Thanks. Sorry about that. Yeah, that makes sense. So I guess like with regards to performance from the ground up, like it's not really intended to be like a super revolutionary strategy that is able to earn high risk adjusted yields necessarily. You're just allowing users to tap into a market of incentives that they previously weren't able to. That was previously like borderline monopolized. Would
Yeah,
there would there
yeah,
be sorry, go ahead.
yeah. It's not possible to like be decentralized and compete with centralized firms. Like
Right.
our whole protocol has a 1 second latency from pulling the order book data, running it through a set of validators, and relaying that back up to the exchange level. It takes about a second. Whereas like if you
Okay.
look at like Tower, right? If Tower's making a market like for any pair, I mean, I don't think they do crypto much anymore, but you're talking like milliseconds. And that's where their alpha is. Our alpha is in democratizing access to these order books that just hasn't been possible before.
Yeah, and you mentioned the comparison to kind of LPing on something like Uniswap. Do you have any like kind of data on those returns like currently? So if I market make on Elixir ETH USDC for spot Vertex, like how will my returns vary from just like LPing on an AMM ETH USDC?
Yeah, so you'd have to look at the like price movements of like we're gonna build a calculator for it because it's pretty predictable. But it almost looks identical to like an IL calculator, where if like you're market making for a perp and Ethereum's price goes up like 30%, right? Like you're gonna see like a similar collateral change to if you were in like a spot pool on Uniswap and like in 50-50, and all of a sudden now you have way less ETH and way more USDC. Obviously, like the spot assets abstracted from that, so it changes it a little bit. Like users are just depositing USDC and not Ethereum for perps, but it looks very similar. I would say that it's a little bit less volatile on the collateral side, and that's because every time, like if you're a Uniswap V2 LP, every time there's an order, like you're part of the fill, right? Because it's like everyone's liquidity spread throughout the same curve. This is a little bit different because there could be small orders or maybe even big orders at top of book all day, and theoretically, like we're not getting filled at all. And so if we're not getting filled, like you're seeing like no difference, right? But you're still earning these rewards from these exchanges. So yeah, it's the end at the end of the day, it's like designed to be as delta neutral as possible. If you put $100,000 to a Bitcoin pair on Vertex, the goal is that really no matter what happens with Bitcoin, at the end of the day, like over a long time horizon, you have 100,000 sitting there plus all the rewards that you've earned from having that money on the books.
What do maker rewards look like for people who aren't really aware?
Yeah, so they vary between exchanges. The one universal thing is rebates. So the core of these programs is typically like a maker rebate, where every time a taker places a trade, they pay a fee to the exchange. What rebates are is that if your liquidity is on the other side of that trade, you get a piece, or in some cases, all of that taker fee. directly into your pocket, which is just cash. So that's like that's the kind of the first universal thing that's similar about all of these programs. The second thing is the outward incentives. So that varies between exchanges. For Vertex, they're paying out like a significant amount of VRTX tokens each month to makers to incentivize liquidity on their books. Um, Injective pays out 60,000 INJ a month to, right now it's three addresses to collect all of that. And I think that, I mean, that's about $1 million, I believe. I haven't checked the INJ price today, but it looks roughly like $1 million a month to like three addresses. And they only have about 5 million of liquidity on their books. So what that would
Jeez.
look like for Elixir, if we brought 5 million of liquidity, doubled their liquidity, which I think is pretty easy given that like in a week we hit our 10 million cap with Vertex, then we would theoretically be collecting like roughly half of those rewards. So that would be like well over 100% APR for depositors. And then for the exchange, it's like they're getting way more money on the books per dollar that they're paying out, right? Versus right now, where it's like they're paying out $2 a month for every dollar on the books. So yeah, it's kind of a game of like capital efficiency for the exchanges, and I think that's why like we found so much product market fit on that side. Like they're already paying out these rewards. They're not creating new reward programs for us. We're just tapping into existing ones and increasing their efficiency by a factor of 2 or 3. So yeah, it varies across the board, but that's kind of what it looks like. On Vertex, for example, we haven't we didn't really know what the market value of Vertex was. So for our pools, we marked it at like the seed valuation. They're doing their LBA right now, and I think they're up 15x from seed. And so the APRs, like once the token's live, will be reflective of that and like significantly higher than what they are right now.
Would you distribute in the token or just USDC?
We distribute in the token, so users will see their rewards, be able to claim their rewards, and then they can choose what to do with it. We're not auto selling it; like we give that decision's up to the user. For Vertex, we also have a 15% baseline APR paid out in Arbitrum tokens. That's because we won their STIP grant. And so for the next like 3 months, like no matter what the liquidity is, up to 10 million, we can guarantee 15% APR on all the pools. Past 10 million, that APR starts decreasing.
Yeah. And you spoke about kind of integrating with other dexes. Where do you see Elixir's integrations being the most impactful? You mentioned injective, and to me, it sounds like there's a world where, with a good amount of size coming from one place, to be able to double something like injective's liquidity and kind of one go and one deal. Do you think they're like, are you going to get any like Elixir specific deals for incentives for that?
Yeah, so where we have an advantage, I guess this is one thing that kind of ties back to something that you guys mentioned previously. You were asking about like alpha and edge on the strategies, and I was mentioning how like at an algorithm level there aren't any. But one area where we do have advantages are special deals with these exchanges, where we have order batching, like wallet batching is one. So all of these reward programs have these pretty complex formulas for how to determine how the rewards are distributed to makers. One universal thing is that they all have minimum volume requirements per pair. So essentially, like on Injective, for example, they have some like less liquid, less traded pairs for altcoins, perps, and anyone making markets on those exchanges isn't getting enough volume on that pair to even be eligible for rewards for it. We, however, have all of our deposit addresses batched across the board. So you can deposit to their less liquid pairs and you're hitting those volume requirements because you're getting carried by the volume done in the more liquid pairs like Bitcoin and ETH. So a normal market maker isn't really able to even take advantage of rewards on those pairs, and that's why there's not much liquidity and not much trading volume. But we are, however, just because we're being carried by the volume done from the other pairs. Very similar thing with like Vertex and all these other exchanges, which is pretty crucial for us because we want liquidity to be able to be spread across the exchange and not just concentrated in top pairs. And the exchanges want that too. So for them, this is a really easy way to I guess broaden their liquidity to even like low liquidity altcoins. Um, so yeah, at the end of the day, it's like it's a weird thing because order book liquidity doesn't look like DEX liquidity for like AMMs, where Uniswap has hundreds of millions, if not billions of dollars, on the bonding curve at any time across all their assets. Like these exchanges are such a like hard requirement for like the infrastructure and level of knowledge needed to provision liquidity on them, that it's just like a few firms that do it and they're just spreading their liquidity thin across like all these names, kind of chasing rewards. And I think that's where Elixir kind of democratizes access and allows anyone to tap into it just like they could on an AMM. So that's where like our biggest edge comes in. That's where our product market fit is. And I think that's where our success has lied so far.
Awesome. Are you excited to see the network market make for any specific type of DEX? Options, prep hybrid, cloud?
Yep. We have plans to be able to broadly support like any kind of liquidity pool across the space, whether it's options or concentrated liquidity. Um, but right now, like we kind of see the perp dexes as a land grab. Like we don't really have any real competition at this point, but that's not going to last forever. And securing like native front end integrations into these exchanges is pretty crucial for us. Just it's like, imagine like going to New York in like the 1850s and buying land on Madison Avenue. That's kind of how we look at this, and so that's our focus for the next like probably 4 to 6 months. After that, like we want to start exploring more broad use cases for the network, which include like CLAMMs and options and everything in between. Even NFT marketplaces, like NFT perp dexes. We've had a few reach out with some interesting ideas. It's just not in our bandwidth right now.
Yeah. Yeah, I think that definitely makes sense. Seeing you guys on the less liquid stuff like options and NFTs one day would definitely be a game changer, I think. I are you guys by any chance like restricted to any chains? Like could you go and market make for like Drift or Zeta and Solana if you wanted to?
Yep, there's no restrictions. The protocol that we built is fully off chain, and so it's interoperable with like virtually any blockchain. The only lift that's required for new chains is the actual smart contracts for like capital deposits. Um, if for instance, like DYDX v4 is built in Go, so we're having to build that integration in Golang. Um, like I think Near is like in Cairo or something, but there's not really anything there anyways. Like there is some level, or like Sui for instance is in Move, so there is some level of like customizability that we have to do. Like there's some tech lift with new chains, but what's nice is like once the contract is built on one of these chains in one of these languages, like any other chain that uses that language, we can use the same contract for. But the actual protocol that does all the heavy lifting with this liquidity, like that can plug into APIs on any exchange anywhere.
Does that include centralized exchanges?
Yep. Centralized
Wow.
exchanges are actually the easiest because there's no smart contract requirements. So,
Hmm.
like there's actually a market making firm that's going to be launching soon that we've been talking to that wants to use Elixir to like power their market making. It's called elliptic trading. They basically want to issue bonds on chain using bond protocol where users like bond their USDC and get tokens in exchange, and then they take as a firm, they take that USDC, they own it, or the project owns it and loans it to them, and then they put it into these sub accounts for centralized exchanges, and the protocol actually provisions it permanently for that pair. So it'd be like a completely new, like super cost effective way for projects to have core liquidity on their centralized exchange pairs without paying like a year contract with a centralized firm. So yeah, there's a lot of exciting use cases. Even someday, like users will be able to connect their trade only APIs and make pairs on centralized exchanges, self custodying their capital in their own accounts. and potentially like earn rewards from the individual projects themselves. Kind of like liquidity mining on Uniswap, but on centralized exchanges.
Okay. So from the start, the decision to build an L1 to kind of meet this problem set was it was it sounds like it was driven by having the ability to integrate with whatever is necessary, and then also having the customizability to build in, everything you need to be able to have that to be able to have like the necessary latency and run the strategy that you do at a fast enough rate. Um, Building an L1 has like, at least historically, as far as I understand it, having never done so, um, is not an easy thing to do to get to the point where it's performant, decentralized, where it kind of checks off all the boxes that are needed. But it sounds like Elixir is like well on its way there, despite being like a 2-year project, I believe. Is there like a reasoning for that? Is it because it's like purpose built for this one use case?
Yeah, well, it's not been easy at all. We've
Yeah.
we've had a lot of people. Like, there's been some projects and stuff that we talked to early on. They're like, "Why is this taking so long?" And it's like, well, like here's what we're building. Like, I don't think you fully understand it and like the complexity of it. It's not just like smart contracts. It's not like a smart contract based application built on one chain using one framework. Like, that's very easy. But building like your own L1's like significantly more difficult. And so, like you said, it's almost been 2 years, and we're still in like an early form of testnet. And we're hoping in the next like 4 to 5 months, mainnet can launch. But it's like that's a very tentative timeline, and it's very complicated. And I don't think we've seen all of the like little issues that come up in a actual performance environment versus in like a testnet environment. So yeah, it's a long process. It's very stressful. We're now a team of 17. And so after a Series A, we were able to like ramp up speeds a lot because we were able to hire out all these positions that we needed that we just didn't have the capacity to hire before. So I think that the speed of development has increased a lot since our Series A. We were doing this on like a pretty lean budget prior to that. So it's been a long journey, but I do think it's progressing kind of how we want it to, and hopefully in the next like six months, 5 months, everyone will be able to see mainnet live, and other projects will be able to begin building on top of it as well, permissionlessly, without needing to even talk to us or needing us to do anything.
You're muted. You
My bad. Yeah, no, I don't know. I mean, the way I think about it, like 2 years to ship and launch a purpose-built L1 you know, doesn't sound like a small task. And like I don't know who would be going and getting like impatient halfway through that, because it's a massive task. And getting it done in 2 years is impressive in my book. Um, I would like to talk a little bit about um the token, if that's all right with you, because there are some mentions of it in the docs. I'm
Yes.
wondering what's the goal of the token once mainnet goes live? What purpose will it serve?
Yeah, so the token will be very similar to any like native L1 token in that it's required for network security. So validators will have minimum staking requirements to be eligible for consensus, and then individual users can delegate their tokens to validators, with the amount that they delegate, kind of tiering them in terms of what percentage of the protocol fees generated by that validator earn. So it's going to be a pretty crucial item, I guess, for our ecosystem. Of course, it'll have governance rights, but for now, like, yeah, I have to say it's a worthless token, worthless governance token, and utility token. That's kind of like the requirement for me to say.
you're muted again.
All right, it's the last time I mute. I don't know if I'd say worthless necessarily. I mean, it's something for people to believe in, and for people to kind of, I don't know, put their faith in, I guess, and as a proxy for the success of the network.
Well,
Are there
just to add
Go
to
ahead.
that, it's more of a legal requirement that I say it's a
Okay,
worthless
gotcha.
utility token, and
Yeah.
less of an actual like flag I'm planting myself.
Right. That makes sense. Is there anything you can tell us about, like, anything that users might be able to do to get access to it? Like, will there be? Have you thought about like what the TG event will be at all? Will there be any sort of like airdrop for Vertex pool depositors or node operators or anything?
Yeah. Well, I mean, it's gonna be important for us. Like at launch, there's really no like in the current form, there would be like no distribution, which is not a good thing. And so it's gonna have to be distributed to users. I can't comment on airdrops or like what that will look like, but it'll be important for users to be able to get access to the token early on, just for like even just for the concept of network security, right? Like if validators don't have tokens to stake or users don't have tokens to stake, um, like it wouldn't be good for the network at all. So yeah, there's no word on what that's going to look like yet, but I think it's always good for users to get involved in networks early on.
Yeah. Yeah, definitely agree. And with a design like this, it's important to distribute properly between validators and then users who can then go and delegate to those
Exactly.
validators. So
Yep.
sounds like you're thinking about it the right way. Um, just to like take a step back and zoom out a little bit. What you've talked a little bit about some cool things that Elixir could be doing in the future, but in terms of like broadly the role that it serves in the space, I saw you did a thread not long ago about there was a line in it that I really liked, which was uh, something like on-chain trader in a couple of years, on-chain traders, or in some amount of time, on-chain traders will be interacting with Elixir liquidity on a daily basis. I'm wondering, like, what role do you see Elixir playing with how the market making field looks like right now? Like, do you guys hope to replace the reliance on these 3 or 4 firms entirely? Do you hope to just eat into their dominance a bit? Do you hope to just change the way that these tokens are bootstrapped, and the way that these tokens have liquidity generally?
Yeah, we want to own the majority of the liquidity across the entire DEX space, and I don't think it's too ambitious of a goal. I think it was an ambitious goal when we started, but now like with Vertex, like we own the majority of their liquidity and TVL right now, and so even on Vertex, like anyone who trades on Vertex, they may not even know what Elixir is, but they're trading into Elixir's liquidity. And I think we have integrations going live with Injective, DYDX, Bluefin, Satori, WooFi, like a lot of big names that kind of like lead volume on the space. And so in a matter of a few months, like once all of these are live, the expectation is that traders on every single one of these exchanges will be interacting with Elixir on a daily basis, even if they don't know it. And then more broadly speaking, longer term, I think once we are able to explore these further applications like options and CLAMMs and everything in between, at that point, it's like if you're trading on chain, there's a really good chance you're trading at least partially into our liquidity. And so that's kind of the broad long-term goal.
Awesome.
Awesome. Yeah, it's actually really cool. This might be a dumb question, but is there a point where Elixir might be deciding where majority of liquidity goes based on the fees that you receive?
Yeah, so it's not a dumb question at all. It's tough. So a big part of an answer to that is like it depends on how we structure governance and like what kind of reaching powers it'll have. Right now, we want to keep it very granular, right? Users deposit per exchange per pair, right? So you don't just deposit across all of Vertex. Like you choose like a specific pair to put liquidity on the books for. Long term, we do have some ideas that we're working on in the background that we haven't announced or really told anyone regarding like an ELP token, which would be like more of like a broader liquidity token that users just hold this token and accrue like the maker fees that come from all of these exchanges. And the big question that leads into what you just asked would be like, how does ELP decide where liquidity goes? So like you buy ELP, or like you would mint ELP with USDC, and then that USDC would be routed across XYZ pools, very similar to like GLP. Um, but instead of like backstopping losses and earning money from gains, you would have like active liquidity on the order books in the background. So ELP would be backed by USDC with all of that USDC on the books earning revenue. Um, the question would be like, who decides and how is it decided where that liquidity goes, especially if
Well,
we're operating with
if
like
you can't comment too much on what the governance might look like, maybe if there are any current live governance setups that you do like, that you're a fan of in terms of
It's a
structure.
good question. I think my answer would probably be actually like none of them. Um, we've interacted with a lot of these, and I've yet to see a single one that's effective and not just like a complete facade. Most of them, it's like you give this illusion of decentralization and it's good positioning from like a legal perspective, but in like a practical world, it's meaningless. I think that there's a combination of things that would be impactful. I think like having like a pyramid system. Like I think all systems of governance like throughout history, like a top-down pyramid system is always the most effective, where you have like decision making power all the way at the bottom, which would be like a small token holder, but the ultimate power kind of flows up to the top, and maybe you have like a council, like a decentralized council of people that like ultimately make final decisions, and the decisions that they're making kind of flow up from the bottom. So people put proposals out from the bottom, they vote on it, it then flows upwards to like a council who votes on it. Like I don't know exactly what that will look like yet, but I think part of that will depend on like what kind of power governance really has over the network. Like, will they be deciding where ELP's liquidity goes? Like, if so, like it's important you have like a really robust decentralized framework, right? And you can't just have like some new exchange somehow games governance and just pulls all the liquidity to them, or like it'll be pretty crucial. And so that's something that we're in the process of figuring out right now.
Awesome. This is it's pretty interesting stuff. I feel like we could have done another half hour, another hour, but we had some hard stops, unfortunately. Any call to action that you have for the people listening? Anything we missed that you want to mention?
No, I don't think so. I think this was pretty comprehensive. But yeah, if you haven't checked it out, you can go to app.elixir.finance and see the Vertex iteration. We're going to be going live on their front end, like where you can manage the positions directly from their application in a couple weeks. So that's exciting. Vertex or Injective will be launching in less than a month. So that's something to keep an eye out for as well. And yeah, if you don't follow us on Twitter, it's Elixir Protocol, one word.
Awesome. Also, one of my favorite names and favorite logos.
Yeah,
It
logo's
probably
pretty
doesn't mean
sick.
much, but it is one of my favorites. So
Thank you. I appreciate that.
thanks for
We,
coming
we
on.
love it as well.
Yeah,
Thanks for
thanks
having me,
for coming
guys.
on. Really appreciate it. All right, that's
Amazing.
Thanks,
episode
Cole.
Have a good one, guys. Thanks so
44.
much.